Just a couple of minutes here before we start. For those who have joined online, hello and welcome. Just trying to see if some more people are trying to log in. All right, so it's 1300 hours, and as promised, we are here at your service to take you through with this very popular and much more demanding topic, PAYE tax, how to understand your payslip, how an individual gets taxed over here in the Republic of Ireland, and what are the regulations around the income, the family income of an individual over here. So first and foremost, I would like to thank you for sparing your time, your valuable time, coming over here with us, having this session today. So welcome and thanks. Through this session, what we will focus on is about the components of payslip. What are the three types of levy which an individual gets? A PAYE tax, the PRSI, and the Universal Social Charge USC. Hypothetically, we will have a calculation-based PAYE deductions and tax credit calculation so that you understand as to where each and every component is being impacted in your payslip. We shall then take you through how the small benefit scheme like bike to work scheme or relevant such other benefits are calculated. We will also inform you, and we would like to inform you in terms of how a 4-year tax review service can help you to get and claim all the tax credits and deductions which are legitimate and eligible for you. And then we shall move on to the Q&A session if time permits. So let's proceed towards understanding and familiarizing yourself with the components of payslip. So payslip will have these 5-6 things which you see in front of you. Your Pps number, any person who has to have a paycheck drawn from an employer needs to register, and that's your tax registration number for an individual in the Republic of Ireland. Pps number determines everything on a PAYE modernization scheme which is ever since 2019 live. This determines your PRSI class as per your employment. There are total 11 different classes in Ireland. What we focus on is the most important 2 classes. The PAYE employees are classed as Class A, and the self-employed are classed as Class S. The deductions depend on the weekly gross earnings. Just to simplify, I would say that every individual would pay about 4% PRSI. This is particularly, I'm talking of employee contribution. We shall see the employer contribution later on. As far as the gross pay, the terminology is concerned, the gross pay is which is the employer promised pay, which is the agreement between you and your employer through a medium of signed contract as to what will be your annual gross pay. Then we have the total deductions, and in the deductions we have under 2 components, which is the tax credit component, and there are other deductions which are eligible. Benefit in kind, the most important aspect of benefit in kind, BIK, which is a kind of crucial topic these days for much applicable people who are into higher class of pay, who are executive and above, who are in the senior management of any company, or are self-employed having a single director company. This component is a non-cash benefit. It is a non-cash benefit, but it's valued in terms of its monetary value. Let's say an example would be a medical insurance component paid by your employer for you. A company car being driven by a director for its personal and private use. A company van given to an employee to perform the duties, but he is using that for off and on journeys to go to the beach or something like that for his own private use. and the free subsidized accommodation. Sometimes companies do pay your rent, half the rent or any component of your rent. You should be lucky to have that, mostly senior executives. But if that happens, so that's also considered to be a benefit in kind. And benefit in kind is added back to the value, the gross pay, which is taxable. So benefit in kind, and then after taking the gross pay, the deductions from the gross pay, benefit in kind, you add them, and then you get the net pay, which is exactly what you get in your bank account. This is just a synopsis of terminology. We shall walk through each one of this term in the coming slides. Let's now see the elements on which your calculations depend. So your cutoff points. Very important is a cutoff point based on an individual's circumstances and his status, his residential status, his marital status, the status of his income, his gross family income, depends on where he lies and where he falls between these cutoff points. A single person will get about 35,300 as its cutoff point. So below 35,300, he's taxed at 20%. Above 35,300, if he's a single person, will be taxed at a marginal rate, which is 40%. A married person, where one spouse is working with no dependents, will be having a cutoff point of 44,300. A married person with one spouse working with at least one child will have again 44,300. The reason I have split this apart is that there are sometimes misconceptions. People feel that if they have children, their cutoff point should move, but it doesn't move whether you have one children, no children, or you have 4 children. You're married and you both husband and wife, both of you are working, then your maximum cutoff point is 70,600. So let's assume that if John and Mary both are married and both of them are working as a PAYE employee for some of the other companies, then the total family income, the money which they bring in, out of which the first 70,600 will be taxed at 20% after taking off the tax credits, and the balance will be taxed at 40%. The second component is the tax credits. So after you have these components, you have the tax credits. So generally a personal tax credit, the thumb rule is that any person has a personal tax credit. What I mean by this is a person who's actually either working, non-working, doesn't matter. His head count in the family, his presence itself gives him a personal tax credit. So a personal tax credit is 1650 per annum. If he's a single person, he'll get 1650, and then if he's employed, he'll get another 1650. So that's how a person who's working will get 3,300. A married person, by that way, who's having a single income, spouse not working, his family tax credit will be 3,300. As I mentioned, 1650 is his personal income tax credit. And the second component of 1650 is the employer tax credit. PAYE employee gets another 1650. As opposed to the PAYE, if let's say a person was having a job and then he decides to quit his job and he goes self-employed, he gets a max of 1,500 per annum. So in that case, he will get 1650 at his single personal tax credit, and then he'll get earned income tax credit, which is 1,500. Over the years, the government of Ireland tries to match the self-employed tax credit with the PAYE tax credit, so that encouraging people to go self-employed and to open up more enterprises in the country, so that there's more jobs being created. So this brings to the individual tax credits, and then you have another tax credit called as home carer tax credit, which is max 1,600. Doesn't matter you have 1 child or 2 child or 3 child, you'll get a set 1,600. The only condition attached here is that either of the husband or the wife one person has to be full-time home and not working. So if, let's say, John and Mary, I'll take the same example. If both of them are working, they get 3,300 plus 3,300. So that's 6,600 because individual plus PAYE. But let's say they have a child called as Keen, but they don't get the home care tax credit of 1,600 because both of them are working. In this case, if Mary decides not to go to work and she decides to resign, and stay full-time as a homemaker, which is a very, very onerous and prestigious way of living as well, because it takes a lot of efforts to be at home and manage the home affairs. If she does so, then the family will be entitled to 1,600 additional on top of 4,950, which is 1,650 plus 1,650. So that's more sort of a synopsis of tax credits. If you feel that I've gone too fast, we're going to see again an example in the coming slides, so then it'll make more sense. After putting off your tax credits and your cutoff points, you get what you pay for is your tax, which is your income tax. And in terms of this, what I'd like to say is that the total income is assessed in a manner that the income tax is the net output by taking into consideration the above two. Any PAYE employee earning 16,500 per annum will not pay any tax. How? We're going to see that in the next slide. So if we see that there are certain points to note in an individual taxation. Income tax depends on your salary, tax credit, and cutoff points, as we mentioned. Assuming a person makes 16,500, the 20% tax slab will be applicable to him because, you know, the first initial 34,000, as we said, that would be 20%. So that's how he gets 3,300 as his tax liability. But that person has a personal tax credit, plus he has an employer tax credit, and that's how that will be knocked off and his tax liability will be nil. I know that this amount is very small, and much of the people who are viewing right now would wonder that why would a person earn just 16,500 to be not applicable. But this is sometimes for people even who enter Ireland after half a year. Let's say a person comes in November from Brazil or India or any other part of the world to work over here and joins a company. His 2 months salary will be less than 16,500. In that case, his tax credits will be more and he won't pay tax. There's also one more thing, that if a student joins after completing his graduation into a new job, and if it's a half year, he might earn this much of money, and by that case, he won't pay tax in that year. Please note that the USC and PRSI is calculated as per normal rates on the above. The only exemption of USC is if a person earning less than 13,000 per annum. Otherwise, he has to pay USC. Those are invincible charges which a person needs to pay, and there's no exemption except a few which are very rare. Additional point to note, just out of this synopsis, what I think, and I was just discussing this morning about that, if a person, let's say he's married and his spouse is not working and he has no children, so in that case the person actually gets a tax credit of 4,950 because individual tax credits of both of them being 1,300, and the person being earning is making another 1,650, adding it to this tax credits, making it 4,950. So if this person decides that I don't want to go to work and I would like to go on my self-employed route and start up my own business, courageous move, he would make about, until and unless he would make about 24,000 per annum, which is about circa 2,000 per month, he won't pay any income tax. So assuming a person makes annually 24,000 per annum, his spouse is not working and he have no children, or whether he has children, doesn't matter. If he has children, he can make more money, though not pay tax, because he'll get another dependent credit, the home carer credit. And by that way, the basic assumption here is that if you're making 24,000 per annum, which is circa 2,000 per month, he won't pay income tax. This is just an encouragement and shout out to those enterprising folks who want to start up their own business. So moving ahead, what we do now is that we'll take a scenario based, given the time which we have. We thought and we put in this work in order to make sure that we calculate it together. So if you are having your pen and paper calculator ready, what we'll do is we'll touch on and we'll do some number crunching over here. So if you see a basic assumption over here, what we have made, because we cannot go through many other pay slips, we just thought that we'll take a standard one which has most of the kind of nitty gritty into it so that we can calculate it together. So if you see a person who's married and his spouse is not working and have no children, this is what, if his scenario is that he's making about 60,000 annually and there's a deduction in terms of pension for 3,000, and where the employer is also giving him a medical premium, pays his medical premium actually for 1,000, then his taxable income comes to 58. So pension is deductible for income tax. Medical benefit, which is a taxable benefit in kind paid by the employer, gets added back. And that's how 60 minus 3 plus 1 gets to 58. So 58 will be his taxable income for that particular year. Assuming we divide this by 12 and we get monthly. And based on which the 5th month's payslip, let's say if we were running a payslip for this person, how your employer would run a payslip or would calculate your tax and give you a payslip. We are going to decode that entire payslip now for the 5th month, which is the month of May. So what's going to happen is this is the cumulative earnings that if you have, assuming you have earned and been with this employer since January 2020, for 5 months, this is how 25,000 will come up. And then you'll have a pension cumulative and then a medical benefit cumulative. And then you have a taxable income, 24,166. So your payslip will look like as follows. So as we mentioned here, the 4833, which is your monthly income, which is taxable, gross income which is disposed to tax is 4833, and we start off with that amount. So this is your starting point, and based on this amount, your gross pay for tax due date, assuming that you have been with this in this employment since the year start and you had no other employment, no previous employments, you come up to 24,166.33, which is A plus B. And by that way, this is the total taxable till date. And then you have annual tax cutoff point of 44,300 given the circumstance of this person being one person earning and no kids. So that's how 44,300 is being his cutoff. And the cutoff point to date has been calculated that if this is annual, what's for the first 5 months? So that's cumulative. Based on which the tax rates, which is 3691, when it comes to 3691, I'll show you there in a minute. The payslip, which looks like 3691, is the cutoff point. So this is the particular month's cutoff point. So that if he's making 5,000 here, till 3691 is 20%. So based on which, what happens is that above that is going to be this amount of 40% being taxed. And hence, the total amount will be 4950 J, the annual tax credit. So if you see the total amount of tax which has been paid at 20% and 40% is cumulatively coming up to this amount, 5974. The tax credits of 4950 will be applied accordingly in terms of the 5th month, how that's going to work. So if you see the J amount has been multiplied by the 5th month divided by 12, you get this much amount of tax credits till date. And the due date, the tax due is 3912 in terms of H minus K. So if you see H, which was actually the taxable, minus K, which is the tax credit till date. So the tax amount is being deducted by the tax credit for that particular month, and this was the purpose of PAYE modernization in 2019, that it's now real time. So the amount of tax credits are applied each month. We understand that we have tax credits for the whole year, but that's been dispersed accordingly. And when the cumulative calculation happens, your tax is calculated on one side, and on the other side, your tax credits are applied for that particular month. So if you see, the tax paid to date is 3130, and because the tax is to date 3130, this is for the month of April. As we started, we assumed that we are calculating it for the month of May. So what has been now till is 3130 has been paid already till April. So the final tax liability will be what was being paid already till April minus what we calculated actually till date. So the tax due. And the difference between the both is what needs to be paid by this month. So that's how the system or the software of your employer calculates your tax. It starts off from what your gross annual income is divided by that particular month. It calculates all the tax cutoff points for that particular month, which is 18,458.33. And from there onwards, it calculates the tax based on that cutoff point, the total tax payable minus the tax paid till the last month, and the difference is being cut out from your payslip. If you would like to see the payslip, how it looks like, you all get it on a monthly basis. Would attempt and try and explain you that for this 31st of May, this is how it looks. That this is an employee's detail in terms of his monthly details. The tax credit monthly, because he is 4950, the monthly tax credit comes to this much. The cutoff point, where particularly he is been having a 3691, anything in this from this 5083, for the first 3691 it's going to be 20%, and after that it's going to be 40%, as I explained in the previous slide. The USC, don't worry about that, we'll take it later on. The USC has its own tax slab, and in the coming slides I'm going to explain that. The PRSI class is as A1, as we mentioned that it's a PAYE employee's payslip, so that's the reason he pays as A1 class PRSI, 4% standard. This is employee PRSI. As we see here, just to simplify, that the payments here represents his actual, this person's actual monthly gross pay. After this gross pay are the deductions for this particular month, and then the payment, which is the actual net payment, which comes in your bank. If you remember the terminology which we discussed at the start of this webcast. So how is this being done? The summary is provided in this here. This is year to date, whereas this is for this particular month. That the taxable gross pay comes to 4833. Now you're going to think that how this comes as 4833, because of the pension which has been already taken off. As I said, that the pension is something which is removed from your taxable pay. It's not taxed on income. Pension is a kind of deduction, and it's taken out of your gross taxable income per month. And that's how USC in that case is 5083. As I mentioned, that USC and PRSI are invincible. You need to pay USC on the gross pension. Even if you take this 250 from here as a deduction for income tax, you can't take it for USC and PRSI. Your employer PRSI, employer pension, which is going to be another additional component of pension being put in by your employer, and net pay is going to be this amount. So if you see the year-to-date figures, it's going to be similar, like 24,166.33 is the taxable gross pay, as because of this is a fifth month. Tax is taken as 3912. This is again year-to-date. The USC, PRSI, employer PRSI, and these two amounts here are just for your information. They don't impact your calculation. So out of this, the tax which we calculated previously, 782, is taken off, 782.37 here. So that tallies. The USC, PRSI are taken off. The pension is taken off as 250 because of understanding it's to be 5%, and medical insurance 69. This year medical insurance 83 and 69 is just the way of presentation. Some employers show it, some don't, but it's a benefit in kind being added. The difference between them is actually being taxed, and that there's a way how to take it back and claim it back. I'm going to take that later on in the coming slides. So assuming this, we here end our calculation. A person making 5,000, 60,000 a year, 5,000 a month, his payslip looks like this, and finally takes home money as 352.3.80 by the virtue of all the available deductions which we discussed, the additions, the benefit in kind, the cutoff points, and the tax credits, which is cumulative, as well as the monthly tax credits. The net pay comes up to 3523. So moving on further, we have the most infamous universal social charge. As I said, that PRSI and universal social charge are something which is added to your taxable gross income, and the only exception for USC is that you pay this for your gross income tax more than gross income, which is more than 13,000. I beg your pardon. So if your gross income is more than 13,000, you are naturally in the loop of USC. And how is explained over here. For that, for the rates for USC for 2020 is for the first 12,012, you're going to pay 0.5. The next amount is 8,472, you're going to pay 2. And then the next slab is 4.5, and then balance is 8. So it's gradual, it's marginal, and USC is taxable on your all total income. So assuming that people who are viewing this right now are not only PAYE, if you have an additional income, an additional employment income, an additional medical insurance which is paid to you, any BIC, the benefit in kind, any self-employed income. There are some people who have a self-employed side income as well as they have an employment income. They need to loop in and declare all the income and then pay USC accordingly. There's a calculation for it. Any rental income, some people have about a couple of other properties than actually the primary place of residence which they live in. Their rental income also needs to be declared, and on that, when you pay the income tax, you also need to pay associated USC. The share option gains, the dividend income, all are also been included in your calculation of USC. The calculation of USC in that particular pay slip, what we discussed, is very similar. It's the slab based, like how we see we start off from the month, the cumulative, and you see over here is not 4833, you see 5083, which is the pension is not deducted, and it's the deduction of pension is available only for the income tax purposes and not for USC purposes. And so it's 5083 as taken as the taxable gross pay for the USC. The gross pay to date is calculated as 20.